Okay, so welcome everyone, and good afternoon, good evening, or good morning to you all, depending on where you're joining us from. We're delighted to have you here today for the fourth webinar in our current series focused on the topic of Pillar 2 and the associated technical, technological, and practical considerations. Today's webinar will be focused on compliance and reporting matters connected to the topic of Pillar 2. A couple of points of admin before we begin. Firstly, due to the number of people on the call today, your mics are all muted. However, we would love you to interact with us throughout the session. So with that in mind, there will be a couple of polling questions as we go, and you're also welcome to place questions in the Q&A box through the session. We will try to respond to questions in the webinar, or we'll otherwise collate and pick up questions at the end of the webinar. We're of course also available for follow-up discussion after the webinar to address any specific circumstance in more detail. So please do feel free to get in touch. And we'll be sharing the slides and recording with you all after the event. So by way of brief reminder, to date we've covered an overview of the technical aspects of the Pillar 2 rules, some jurisdictional nuances, and also technology considerations, and all of those recordings are also available for you to view. Through those webinars and polls we have run, as well as subsequent discussions we've been having with businesses, we've learned that tax teams around the world are still at fairly early stages of navigating the legislation in a lot of cases. Significant reliance is expected to be placed on the CBCR transitional safe harbor in particular. Tax teams are really struggling with the jurisdictional nuances, the differing timelines of implementation, and bringing together global tax teams in a coordinated fashion. Tax teams have started to model the impact of Pillar 2, and the technology solutions to support in that have been explored, but many decisions are still yet to be made. The majority of teams are expected to either co-source or fully outsource their Pillar 2 compliance propositions. So from my perspective, I just reiterate a couple of key points before we begin. First, there is a compliance burden irrespective of whether there is a top-up tax. So if you're in scope, obviously we need to be engaging with that. Disclosure obligations have accelerated Pillar 2 work in recent months, and we do expect that to continue. And we expect audit obligations going forward, where there is potential to be cash tax impact, to be more extensive than may already have been experienced where it's a disclosure-only obligation. And finally, although the first tax returns are not due until mid-2026 at the earliest, there is a lot of preparatory work required to support audit disclosures and ultimately enable tax return submission. And therefore, our intent today is to provide some practical guidance around the next steps to take from here in your journey. So with that now framed, I'll hand over to Ed.
Thanks, Ross. So this is an overview of what we're going to be covering today. I'm going to start by talking about our compliance and reporting roadmap, which highlights some of the key things that you're going to need to be doing to ensure that you're compliant. I'll then talk about compliance strategy and the things that you're going to need to consider there. Hettel will then talk about safe harbors and their relevance from a compliance perspective. She'll pass on to Jon, who's going to be talking about reporting aspects of compliance and reporting. And then we'll go back to Scott, who will give us a US perspective on these things. So we move on to the next slide, please. So before we get into all of that, we thought it'd be useful just to start with a question of the audience, which is, what stage are you at on your Pillar 2 compliance and reporting journey? And we have 4 options. So first one is we have a well-defined strategy and we are currently in implementation mode. Second one is we have a strategy that we are planning to execute but have not as yet done so. Third one, we have started to develop a strategy and have considered execution. And then the fourth one is we have not started to develop a strategy as yet. So those are the 4 options. Just give it a little while just for some of those answers to come in. Be quite interesting to see where, as it always is, to see where people come out on this, just given that we are quite a way now into that first Pillar 2 period for many people. So interesting to see how far down the road everybody is on this. Okay, and we've got some results here. So in the top one, so defined strategy and currently executing, 9% of people who responded said they were in that one. Second one, so we have a strategy that we're planning to execute. That was 20%. Moving down, started to develop a strategy, but not quite there yet. That's 35%. And then the most popular answer is actually the fourth one, which is we've not yet started to develop a strategy, in which case, very timely that you are in this presentation today. Great. So if we move on to the next slide now, please. And then if we move on again, please, sorry, yeah. So I'm going to start by talking about compliance and reporting roadmap. So this that you can see on the screen sets out all the things that you're going to need to do to be Pillar 2 compliant. And for these purposes, we've assumed a December year end. So obviously, if you're not December, these dates need to shift in accordance with whatever your year end is. Along the top, we've got the key milestone events, such as the submission of the various returns. And you'll notice that stretches all the way into 2026, but don't be fooled. There's plenty to do before then. Along the side, we've got the key actions that are split into three groups. So the first is compliance strategy and data readiness, which I'm going to talk about. Second is safe harbors. Aforementioned Heather will pick that up. And then the final one is the compliance and reporting aspects, which Jon will talk about. Important to note that this picture that we've got up now is only the obligations you have in relation to your 2024 accounting period. As you get further along this into the later dates, you'll actually be doing things in relation to later periods as well. So it actually does become busier as you go through if you to factor in later periods as well. If we move on to the next slide, please, and again. So this is just another version of it with the compliance strategy and data readiness aspects highlighted. So three things I'm going to talk about here. The first one is strategy decision. So what is your strategy? Are you going to insource? Are you going to outsource? Or are you going to co-source? The next one is data readiness review. So I'll talk a little bit about that. And then the third bit is actually implementing things once you've developed that strategy. So we move on to the next slide, please. Back again. Ooh, one slide. There we go. Excellent. So from a compliance strategy perspective, really the key question that you need to answer is where do you want to sit on the insource or outsource continuum? So on the left of this, we've got a fully insourced model in which you plan to do everything in-house. On the right is the fully outsourced model where you're going to get an external provider to do as much of the work as possible for you. And we've highlighted some of the key considerations that you'll want to think about when deciding where you want to sit on this line. On the left, so the full in-source model, the key considerations there really are going to be what technology are you going to need to use to undertake and importantly as well to manage the process. So it's not just about the calculations, it's also about how you manage your process and whether you have the internal capability and resources to do that. I'd also add on that point, even if you do have that capability and resources, the question there is that really where you want to be directing this resource, or are there other more value-add activities that you might want to use for your resource? Sorry, I was just playing around with my video there. On the right-hand side, when you're into the fully outsourced model, there's a question as to whether you want to use one provider or multiple providers. So it's not necessarily the case that you'll use the same provider for everything. And if you are going to split it, how will you do that? So for example, you could use one provider for doing your IIR global calculations, and you then may choose to use local providers for doing QDMTT, qualifying domestic minimum top-up tax compliance in their territory, and potentially the local filings that are needed there. And it's not necessarily the case that it would always make sense to use one provider for everything, particularly if you already have a global compliance and reporting outsource partner, and you may not want to use them for everything everywhere. Another point on here is just provision of data. So one thing I really do want to highlight here is that outsourcing doesn't mean that you then don't have to worry about data, which I'll talk about in a moment. So one of the things you do need to think about in an outsourced model is how are you going to provide that data that's necessary for the calculations to the outsourced provider. And then the last point on here is just beware of tech lock-in if you're using an outsourced provider. So when making that selection, how tied in are you to a provider's platform, and how easy would it be to move if your priorities or needs change in the future? The middle one is co-source, so where you do some of it in-house and internally and externally. And the considerations here are really a combination of the two more extreme ends of the continuum. Irrespective of where you sit on the continuum, there are some things that are going to be necessary to think about across all four. And they're at the bottom, hopefully mostly self-explanatory. The one I would pick up there is whether you have a separate reporting and compliance approach. So if you're thinking about, there are two sort of sides to this. One of them is the compliance side, which is filing all of the returns from 2026. The other one is you're actually going to need to report this stuff in your statutory accounts. And it may be that you adopt a different strategy for each of those two aspects in order to make sure that you're compliant. We move on to the next slide, please. So on this one, so this is data readiness. So boiling all of this down, the key point here is you need to understand what you have from a data perspective versus what it is that you need, and then working out how you close that gap in order to make sure that you're compliant. So many of you will have seen, I think, there are various lists of data points flying around, and most of them freely available, with typically quite a scary number of data points and number of pages in those. The reality for most people is that the actual list of data points that you're going to need is probably going to be somewhat less than that full 7 or 8 page list, depending on which one it is. So that's the good news. The less happy side really is that it's unlikely that you're going to be tracking all of that at the moment and have it all easily available. So the diagram on the right of this slide is just an example that we've used for entity data, which based on our experience is where things tend to be easily available, what may exist and what we're tending to see doesn't exist. And this will be different for everybody. But the main point here is that you need to do the work to understand where those gaps are, because if you don't have the data, you can't do the calculations. On the question of what's the scope of this type of exercise, so there's a question as to whether you do a full global program of looking at data in all of your territories and fixing gaps, or whether you take a more focused approach and just look at those territories where you think you're going to have to do full scope calculations as an example. The danger with the latter one is you are sort of making yourself a hostage to fortune, in that you may think, for example, a territory is safe harbour compliant and therefore you don't need to do full calculations. Something happens, you get past year end and all of a sudden that exemption doesn't apply, in which case that then leaves you in quite a tricky position if you don't have the data ready. I've said before, outsourcing is not a solution to data gaps. You still need to provide data to your outsourced partner to enable them to perform the calculations, although obviously you can get an outsourced provider in to help you with the data analysis. And that's something that we have been working with some of our clients on so far. The final point on here is just something that Hettel will pick up later, which is that as well as making your life difficult from a calculation perspective, data issues can also affect your access to safe harbours. So just reiterating that this is really important to focus on. We move on to the next slide, please. So this one is process and systems implementation, which is obviously a bit largely self-explanatory. So clearly, once you've decided on a strategy, you're going to need to execute on that. Some of the things, many of the things perhaps that you'll need to do are going to take some time, particularly if it involves systems changes or changes to processes, often involve many stakeholders. So the key message here is not to underestimate what needs to be done. So even once you've got the strategy, that's sort of step one along the road, but implementation is also very important. It could be quite a significant undertaking. As well as some of the more obvious compliance aspects, I guess the only other point I would make on this slide is the one that says it's really important that Pillar 2 compliance obligations get properly embedded in the organisation, such that when you've got any tax planning going on, or when you've got an organisational change, a business change, that you know that Pillar 2 is going to be considered as part of that change. So this is something that's around now. It's going to be relevant for the foreseeable future. So it's really important that any business changes that you're enacting, you do think about Pillar 2, and that you've got the processes and controls in place to make sure that that happens. So we move on, and I believe I am handing over to Hettel at this point, who's going to talk about safe harbours.
Thank you, Ed. As Ed said, I'll be talking about the practical aspects of a transitional CBC Safe Harbour assessment and some of the key problem areas that we're seeing from our recent experience. So if you move on to the next slide, you can see from this timeline that we are recommending that a safe harbour is undertaken much earlier on in an accounting period, and you'll see why we were saying that as we go through the slides. It is a two-step process which requires a qualification assessment that I'll talk about in more detail in a later slide, and a safe harbour assessment, which is the actual calculations under each of the tests. The implication of this is that the data collecting process for the CBC report will have to be accelerated much earlier on in the year than what businesses may have historically been used to. So if we now move on to the next slide. This slide is just a reminder of the key conditions to access safe harbours and the relevant tests under each of the safe harbours. I'm not going to go through this in any more detail, as this has been covered in our first webinar of the series. But there are 2 points that I would like to draw out on this slide. And the first one is the once out, always out rule, which means that a jurisdiction cannot qualify for a CBC transitional safe harbour if no election was made in the prior period by the M&E group in relation to that jurisdiction. And this is relevant for US-headed groups where an election may not have been made in respect of US, given that Pillar 2 rules were not in scope. And so no election can be made in a subsequent period when US may come into scope under other provisions such as UTPR. Therefore, safe harbour elections should be considered on a group-wide basis, regardless of the status of implementation of Pillar 2 in jurisdictions. Another point on this slide that I wanted to draw out was around the QDMTT. So if groups are operating in jurisdictions that have implemented QDMTT, they will also need to consider the application of CBC safe harbours, not just for income inclusion rule purposes at the parent entity level, but also for QDMTT purposes at the entity level. If we now move on to the next slide. So this is a qualification assessment, and there are 2 elements to this. So the first one being whether the CBC report for a jurisdiction is prepared from a source of qualifying financial statements, which is broadly accounts used to prepare consolidated financial statements of the ultimate parent entity, which is a top-down approach, or financial statements of the constituent entity, which is a bottom-up approach. And the second element to this is the consideration of the OECD administrative guidance that was issued in December 2023, which places a lot of emphasis on understanding the process of how data from qualified financial statements make their way into the CBC report. So the 2023 guidance was helpful in that it provided clarification in some areas, which is that qualification of a CBC report is tested on a jurisdictional basis. So it is possible for a CBC report to be qualifying for one jurisdiction, but not for another. Groups can use different sources of qualifying financial statements for different jurisdictions, as long as there is consistency across all entities in that particular jurisdiction, which means groups do have the choice to use a top-down approach or a bottom-up approach in different jurisdictions. Whilst the guidance was helpful, it has brought a level of uncertainty with it in how some common group reporting processes and policies can impact the qualification of a CBC report for a particular jurisdiction. And we're seeing this mainly in the context of manual adjustments being made by groups as a result of their policies and processes to the data that's been derived from qualified financial statements, including cases where these adjustments are being made to ensure accurate CBC reporting. However, the guidance says that no adjustments should be made to the data drawn from qualified financial statements unless it's specifically permitted under the guidance of the rules. And I'll talk through some of the examples of how this is impacting groups. So what we're seeing in practice is that some groups are reporting on a divisional basis as opposed to a legal entity basis. And then when it comes to CBC reporting, they're manually having to adjust the data to report on a legal entity basis. Now, given that no adjustments should be made to the data that's being drawn from qualified financial statements, this puts a level of risk on whether such practices could impact the qualification of a CBC report. Another common area we're seeing is where groups have a doing sub-consolidation, which is very common, where sub-consolidation happens at a lower level, and then it's the sub-consolidation data that feeds into the ultimate parent entity console accounts. Again, you've got the same issue of having to manually disaggregate data for the CBC reporting purposes, and this could bring a risk that your report may not be qualifying for the jurisdictions that are involved in the sub-consolidation. Another area that we're seeing group reporting processes or policies having an impact is on transfer pricing. And this is mainly around accounting for recharges whereby some groups are including recharges which should be correctly reported as revenue as credits against the expense line, and then making manual adjustments in their CBC report to correctly reflect these amounts as revenue. And whilst this is correct, it is again making adjustments to the data, to the core source of data, and that could result in a risk that your CBC report may not be qualifying. We've also seen cases where, due to historic group policy, management recharges are being reflected below the PBT line. From an accounting perspective, these do not impact the console accounts because it all nets off, but all of these adjustments means that it's adding a layer of risk to the qualification of your CBC report. Another area that I would want to talk about is the permanent establishments. The data for permanent establishments should be reported separately on a CBC report in which the jurisdiction is located, and it should be separate from the main entity on which it is a part of. And this is required under both the OECD guidance and under the administrative guidance for the safe harbors. But what we're finding is that historically groups have not reported this separately. It's been included in the jurisdiction in which the main entity, where the main entity is located. And what this means is that it can impact the qualification of your CBC report, not only for the jurisdiction in which the PE is located, but also the jurisdiction in which the main entity is located. So businesses are now having to review their reporting processes around this as well. Another point on PEs is around where the data is obtained from a source of qualified financial statements, where there is some flexibility in relation to permanent establishments. Again, businesses are finding that they're not, that they don't have separate records for PE and are using sources of information which are not explicitly mentioned in the guidance. And so again, that is putting a level of risk to the CBC qualification process. So these are just a handful of the items we're seeing, and it just gives you a flavor of how important it is to review your group reporting processes and how this feeds into your CBC data, as it can easily make a CBC report not qualifying for a particular jurisdiction. And that's why we're encouraging clients to look at their safe harbor assessment much earlier in the accounting period, so that you have time to fix and remediate any issues out there. And all of this will require engagement outside of just text teams, because you will need to speak to wider finance teams within your organizations. CBC process review is also going to be a key piece of documentation when it comes to audits for periods which are in scope of these rules. And therefore, there is going to be a lot of scrutiny on whether a CBC process is qualifying or not. So do not assume that because your CBC report is prepared from qualified financial statements or accounts under a particular standard, that it could be qualifying, because it can easily be not qualifying due to a particular group reporting process. And finally, after this, we would go on to the Safe Harbour assessment once we've done the qualification assessment, which will then help you feed into your disclosures and tax provisioning. And so at this point, I will now hand over to my colleague Jan, who will talk you through the disclosures.
Yes, thank you, Ethel. Yeah, I agree. The CBCR safe harbors will feed into the tax provisioning, the interim calculations, and we will expand on that in this session. We'll now discuss the reporting requirements, which relates to the tax accounting for financial statement purposes, the interim reporting, and eventually the actual filing with the local authorities. And we will discuss these items one by one. Maybe we can go to the next slide. And yeah, looking at the schedule here, the disclosure requirements for the year 23 should already be completed or work in progress. You can see that on the first item. So for the group reporting, usually the work is already completed, and for statutory reporting, generally it's still work in progress, work to be done. The second item, interim reporting, might already apply for Q1, especially for US listed companies, and is more spread during the year, in line with the CBCR safe harbor calculations. For year-end calculations, the year 24 is maybe a special year where we say it's a good year to start early, maybe already half during the year, to assure that the process is well prepared, and perhaps it's good to have a hard close during the second half of the year to avoid any surprises before year end. And then eventually there's an actual filing that needs to follow. So first, recap on the disclosure requirements for 23 on the next slide. So for IFRS, the IASB concluded that top-up taxes should be treated as income taxes, and they issued amendments to IAS 12, which are applicable as from 2023. So for countries that timely adopted the rules like the EU and the UK, these should be followed. On paragraph 4a, IAS 12 4a, there's an exception for recognizing deferred tax in relation to Pillar 2, so it's not permitted to recognize or disclose deferred tax positions in relation to Pillar 2, and that is a huge relief because the valuation would be very difficult. However, it's still very recommendable to track the deferred tax positions, as these do have an impact on the covered taxes that eventually roll into the tax calculations, the top-up tax calculations for 24. So in addition to the exception, there's also a disclosure requirement on the exception. It's required to disclose that the exception has been applied, so that's really straightforward. And on 88C, for years that Pillar 2 is substantially enacted in a year in a country and not yet into effect, which applies to 2023, companies are required to disclose qualitative and quantitative information, if possible, on the expected exposure. So what we've seen in practice on this, As qualitative information, disclosures mention mainly the main jurisdictions in which the exposure would be applicable based on the 23 figures. And these countries' reference is regularly made on the low statutory tax rate or application of specific tax incentives. Countries that we see more than average in these disclosures is Hong Kong, Singapore, Switzerland, Ireland, the Emirates. Further, what we also see is that the impact for 24 that is typically less than based on the 23 figures because of changed legislation or changed circumstances. And it may be good to include a sentence on that as well to explain what is the expectation for 24 if the impact is less than for 23. So for quantitative information, we generally see that companies include an indicative range of the total tax impact of the new legislation, or just a percentage on the ETR impact, which is relatively low, generally below 1%. So that's for the IFRS accounts. For statutory financial statements, these are generally prepared on local GAAP, and therefore it's relevant to understand the local GAAP rules, which may be different from the group standard. So yeah, and even not only from the group standard, it can be different country by country. So on qualification of the tax itself, whether it's an income tax, but also on the disclosure requirements. So for example, in the Netherlands, for larger companies, it's mandatory to explain whether there are Pillar 2 group recharges. And for the UK, in circumstances, there can be an exception for disclosures. So that's something you need to understand, to verify, and that can be a challenge if typically the statutory accounts are prepared locally while you have a central tax team involved in Pillar 2. So these teams should really be in contact, or even the central teams with the local accountants to understand the requirements in this regard. So on the next slide, we go to the in-scope period. So as from the years that Pillar 2 is into effect, which is 2024, for example, for UK and for the EU, the disclosure of 88C is no longer required. Instead, now we need to report the actual current tax impact and need to disclose that separately from the other income tax charges. So for countries that have enacted the rules but not yet into effect in 24, but in the following year, in 25, for example, still disclosure 88C will apply. So we see in next year, there will be a combination of actual tax charges and the qualitative and quantitative information on countries that will apply it in the next year. And still the exception for deferred tax and disclosure thereof continues to apply. So that brings us to the interim reporting on the next slide. So interim tax accounting requires companies to use the best estimate of the effective tax rate to determine the worldwide tax provision, which is now including the global minimum tax as from 2024. And as some of you probably have experienced, it requires quite significant investments to get the process up to speed and implement a successful, repeatable process. And on this process, Scott will discuss his experience in a few minutes, but just want to flag a few crucial items. First of all, the best estimate of the ETR should be based on the substantively enacted Pillar 2 tax law as per the reporting date in each of the jurisdictions. It is expected that some of the countries will introduce the rules retrospectively, like Spain and Cyprus, and which may have a direct impact from that moment. So that's something to monitor. We also see increased local tax law changes that may affect the ETR calculations, like adjustments in tax rates or new tax regimes like Bermuda. adjustments in other rules like CFC, and R&D credits to comply with the Pillar 2 rules like Belgium and Ireland. So all these legislative developments should be monitored closely to apply it correctly. And for the implementation status, in the bottom of this slide, you can see a link to the BDO tracker, and you can find the current status of the implementations. So then the continued safe harbor analysis, as mentioned by Ethel, are also important for interim reporting to make a selection of the countries for which you will have to do a full globe calculation. And then most importantly, like mentioned earlier by Ed, it is key to obtain and understand the relevant financial data. Preferably, the company has already been able to map in advance all the data points that they need, which is a huge challenge. And likely it's not possible to get all the data from the ERP system. So you have to find sources to get the data or make assumptions if not all the data is available. And to avoid surprises, it is crucial that for Pillar 2, the considerations and implications of transactions in the business through tax planning and are considered during the period. So, for example, in the Netherlands, if there would be a liquidation loss and that can be claimed, that would reduce your actual tax charge, would reduce your ETR, and that's something you want to be aware of, so you can take measures or at least report that correctly. So the collaboration between teams is very important here. So then to process the data eventually into the calculations, both technology solutions and the more advanced Excel modules could work well. The best choice here depends on the complexity of the structure and the complexity of the actual calculations, but at least it's a crucial factor to have an effective integration in all the processes of the company, also with other tooling. So spend time on that, I would say. And then so the importance of the calculations will increase heading towards the end of the year. So any assumptions made during the process should be evaluated, monitored to further optimize the calculation, the quality of the calculation in the following periods. And if needed, this may be a good time to obtain some further budget for further resources for technology, if that's really necessary. So as mentioned, Scott will expand on this topic in more detail in a minute after we briefly discuss the compliance requirements. But first, we now go to our second polling question, which was already on the screen earlier. And some of you already voted for that. So what was your approach to the first interim calculations, or will be your approach to the first interim calculations? Did you prepare that yourselves by using Excel or other internal developed tools? Was it prepared by yourselves with new technology? Was it done by an external party, or was it not prepared at all? And so some of you already voted for this. I'm not sure whether you all can vote again. And from the first results, I saw that Excel was still very popular, which makes sense at this stage. Doesn't mean that's the best way, but you don't want to invest in technology if you're not certain that it's the best solution. And I also saw that there are quite some people that voted that not prepared any calculations at all. So there are the results. Yeah, it's still the same as what we saw earlier. And yeah, new technology is not used that much, only once. Yeah, so I think with that we can continue to the compliance requirements. Ed?
Thanks, Jan. If you just there we go. Next slide. I'll only be very brief on this one because I'm conscious of time. This is just an illustration of the returns that you're going to need to file as part of the main QDMTT and IIR filing requirements and when you're going to need to do it. So two key dates really, 30th of June 2025, which is when you're going to need to register with tax authority, which may be HMRC for a UK headed group, and then 30th of June next year, which is when a whole heap of returns will need to be filed both in the top parent jurisdiction or your top company if you don't have a UP that's implemented, and also all of your in-scope jurisdictions as well, which is the final requirements in blue at the bottom. One quick health warning with this, the dates of the filing of the local returns, for example, QDMTT returns, do not all align around 30th of June. So, for example, the Netherlands has a different filing date to the UK. So this is a UK example. So it's really important to make sure you understand what needs to be filed in every jurisdiction and when, and then build that into your compliance plan. So next slide, please, which I believe is the point that I pass over to Scott, just to give some perspectives from the US side.
Great, thanks, Ed. Appreciate it. So I think we only have a few minutes left, so I'll try to run through some of these items quickly. We could go to the next slide. So we've all been quite busy in the US despite not having adopted Globe rules, in part due to our love for holding companies. Probably has us expedited heavily for this year. The other part, the under tax profits rule, which I think is really kind of kicked everyone into gear in adopting or will adopt Pillar 2. So it's been key to get organized. That's what I think groups have been struggling with quite a bit, is getting organized. And so we found kind of early in the process that it's critical to do a guided Globe profile. And so we've created a Globe information checklist to do that. And the list keeps growing, which is great. It's really important working with an experienced partner, because the reason that list keeps growing is because we keep identifying issues and then we add it to our Globe information checklist that we discuss with our clients. One recent example, we just had an issue the other day with withholding taxes that were included below the line rather than as an income tax expense. And so the company needed those withholding taxes so that it could pass simplified ETR. Well, we caught it in time and we're moving the location of the withholding taxes. So we have numbers of those lists, of those items in the list. And I think it's really important kind of getting at this early on. So if we're profiling for the transitional CBCR safe harbor, does the group have related party payments that give rise to a deduction in one jurisdiction, but that are disregarded from income in the recipient's jurisdiction? So do we have a hybrid deduction issue? Or does the group have entities that don't complete audited financial statement data on a single legal entity basis? We've seen it on a jurisdictional basis, incorporating management reports that aren't eliminated. So this is a safe harbor disqualification issue. But if we get it early on, we can find it and we can try to fix it. That issue's been a little bit more difficult, but many of them are fixable. One that's so key, because everybody thinks, well, I'm in Mexico. Mexico has a 30% effective tax rate. We're good. We're going to pass simplified ETR. One of our clients that we worked with, they wanted to do a trial run where we did all of the 2023 analysis in advance. And thankfully we did, because what happened was they had valuation allowances in Mexico, and those valuation allowances are being released. Well, that drops the effective tax rate below the simplified ETR rate. And there we go. Now can't use Mexico for simplified ETR, even though it's got a 30% stat rate. So this has been key. Profiling we probably have a list of about, I think we're probably over 300, 350, where we have these questions that speak English. Does the group have entities in a jurisdiction that does not tax interest income? Yes, we all have to come to the table with the departments and discuss it. But once we identify it, it's much better because then we can focus on what rules specifically apply to us. If we don't have insurance companies in our group, that's great. That's a couple of our questions. And then we can mark that down, which is great for controls, and move on. We don't have to consider insurance companies now, or the GLOBE provisions that apply to them. So I think that checklist has been really helpful. Then we have also seen a lot of companies for now have a tendency to apply assumptions. In fact, in our checklists, we have a spot for denoting if something's an assumption or not, so that we can get organized and need to validate that, or later if we come back to it. A really popular question I've seen asked on every interim period audit for our US headquartered multinationals has been to provide a list of all intercompany transfers of non-inventory assets since November 30th, 2021. So I probably have 8 or 9 public company audits going on right now. Every one of them has asked this question. So they say, okay, we see you've made that, but now for Q2, we're going to expect that you show us the procedures that you've undertaken to validate that assertion. So we're another area to improve hygiene, topside adjustments. Everybody loves to make topside adjustments. Well, we need to work on pushing those down. So I'm talking, maybe one more point, because I know that we're out of time, but it's been data collection. So it's great for the company to have GLOBE profiled their companies to determine what data is needed, but executing on that data collection process has been quite difficult. So in some cases, our teams are even provided laptops from the company, et cetera, but there still needs to be somebody at the company side who's kind of maintaining control over all this. And what's been most effective for our clients, when we've got C-suite level that come and have a presentation, I've had 2 of these now, where we bring all the departments together, HR, Treasury, accounting, domestic tax, FP&A, information technology, local country controllers, and they see that it's got the backing of the C-suite, and then we have a designated project leader from the company. That has been, really great. Other companies that haven't done that, I've seen some of these, data pulls kind of passed around like a hot potato. That's been much more difficult. So I think one last point I'll make that was really interesting, just for the benefit of the group, is loan agreements. So we saw in one of our clients that was issuing a loan via syndication, where in the loan document itself, it had a precondition, right? So they wanted to see, the lenders wanted to see a GLOBE analysis by country to assess if there would be a potential material impact. So I thought that was really neat to kind of see that Pillar 2 has made it into the loan documents now. So yeah, I think it's just continuous improvement for the second quarter. It's all about right now process documentation. The auditors know there's so many rules that are out there, right? And we're going to narrow them down through our GLOBE information checklist. But we're still talking about hundreds of rules that require hundreds and hundreds of data points. So they want to see, and rightfully so, have you considered all of the potential issues? So that we know that you've got a process in place. So we've been helping clients with process documentation, flow charts, memoranda, et cetera. So I know I didn't cover everything. One last point, key to every single audit actually has been the GLOBE entity classification analysis. So it's been kind of so streamlined that now we've developed kind of a template for that particular request on doing a GLOBE entity classification, going through each org chart, going through each entity in the org chart. And then, we have kind of a systematic way now to do that, because that drives the entity location, which drives the GLOBE tax and income adjustments and allocations. So that's been one item that's been critical. So a lot of lessons learned, key to working with an experienced partner. And I think, Ross, with that, I know we're over time, but I'll turn it back to you.
Excellent. Thanks very much, Scott. So hopefully everyone's found that a useful overview of how you might approach addressing your compliance and reporting obligations. I think just a few key takeaways and observations from my side. So first of all, it's still the case that the rules are complex, and if anything, the more we look into the rules, the more complex that they get. So there's very likely to be a significant amount of work to do to assess the real impact of the rules for your organization. So I just encourage you, if you're not already in the process of actively thinking about your compliance strategy already, you likely should be. Second, there's a need to determine how you want to approach your Pillar 2 compliance. What will you look after internally? What will you outsource in the context of no doubt confined resources, and how is human capital in your organization best spent? Although we've been talking about this from a compliance and reporting perspective, I think it's really critical to stress that the Pillar 2 rules are live now for many organizations. And if you're in scope of the rules already, all transactions that you're undertaking should have Pillar 2 analysis as part of the scope of the taxes that are considered. Otherwise, you may well find yourself in the point of having unexpected tax outcomes. I think there's also a piece that certain historic processes can be accelerated and should be accelerated, the country-by-country reporting process being one of them, as Hetal mentioned. So whilst the transitional CBCR safe harbor is a welcome administrative relief for many organizations, the ability to rely on it should not be assumed. As Hetal mentioned, there's a number of really practical issues that we're seeing arising, and you should make sure that you're undertaking appropriate diligence and also giving yourself time to address any systems related limitations, because a number of the points that Hetal was talking to where there's challenge in the qualification of the CBC report are a function of challenges in the underlying data and the way systems are reporting that currently. Finally, don't lose sight that this presents an opportunity to establish a business case for investment in data, process, technology, and people. So it's not just to think about it in the context of addressing Pillar 2, but also to enable a more nimble and effective tax and finance function generally. So do keep that holistic view front of mind when you're thinking about how you might raise this with stakeholders in your organization, including thinking about the training and process requirements across your organization and the opportunity that Pillar 2 might provide to really improve and upskill in those areas. So there are a number of further resources that are available to you, including recordings of past webinars, and the links will be available in the slides that will be shared with you shortly. We'll also be undertaking a survey following this webinar to learn more about the international tax topics that you would like us to cover in future webinars. That could be Pillar 2, but importantly, we're also interested in your thoughts beyond Pillar 2 to keep the conversation going, because Pillar 2 is obviously just one of the issues that international businesses are dealing with at the moment, and we'd be really grateful for your input in shaping that series. So with that, we'll just give a final opportunity for any questions. So I can't see any questions coming through, albeit I seem to have lost access. So if any of my panelists see questions coming through, do let me know. Nope. Doesn't look like there's any further questions. So with that, thank you very much for joining us. Hopefully we'll see you again soon, and do feel free to get in touch if you'd like to discuss any of the matters that we've spoken about today in more detail. There will be details of all the speakers from today in the slides, and they are being flashed up on screen for you now as well. So with that, enjoy the rest of your day, however much of it remains, and hopefully speak again soon.